Good afternoon, everyone, and welcome to today's webinar about planning for trade uncertainty. This is the first in a series of shorter sessions the Institute of Export and International Trade is running about trading in uncertain times. My name is William Barnes-Graham, the Senior Content Editor at the Institute, and I will be your host for the next half hour or so. Next slide, please. So we're going to begin today's webinar with a poll to understand a little bit more about you, our audience. So if I launch this first poll now. So we are here asking about what is your level of confidence regarding doing international trade in the current post-Brexit landscape. The options range from very confident to not at all confident, and there's a not sure option as well for good measure. This is a poll with clear and continued relevance to today's topic, so your answering it is very much appreciated. While you are answering that, just a couple of quick housekeeping notes. Firstly, you can contact me with any questions or comments using the question panel on the control window to the right-hand side of your screen. We hope to get to a number of your questions towards the end of the webinar, though please bear in mind we have received a lot of questions in advance, so we'll not be able to get to all the queries we received today. If you feel as though your question has not been answered, please do review our technical helpline or training and consultancy offerings, which we will be talking about later in the webinar. And a quick tip on questions: if your questions are easy for me to understand and read, I am more likely to ask them, so please do try to keep them quite concise and clear. Secondly, you will receive access to today's slide pack and a recording of the webinar in a follow-up email we will be sending over the next day or so. So please do try to listen in as carefully as you can to today's presentation, because you will be able to read back the slides at a later time. Righto, I'm going to close the poll in a couple of seconds. Let's give you one last chance to respond. And I'm going to share the results. So really interesting as ever. 18% of you are very confident. Over half, 51% of you, are saying quite confident. So quite a confident audience here today. But 19% not very confident, 5% not at all confident, 7% not sure. And this response rate does vary a lot depending on the audience. So thank you everyone for answering that poll. If we move on to the next slide, though, it is my delight to be joined today by Hamish Mackay, a trade and customs consultant with the Institute, for his webinar debut with the Institute, in fact. So great pleasure to have Hamish with us today. And we'll be joined later on by Arshad Dadaboy for the Q&A. Arshad is also a customs and trade specialist at the Institute. We have quite a lot of them, as you can probably imagine. So great to have both Arshad and Hamish today. Now, Hamish, it was a really interesting response to the poll from our audience as ever, but could you explain to me something before we get going? Right, so Brexit has happened, the transition period ended almost a year ago, and a trade deal was signed. It was about Christmas time last year. So why would Brexit be continuing to cause uncertainty for traders?
Well, thank you for the question, William. It's interesting, of course. We had the perfect storm, didn't we? Brexit and a global pandemic, which nobody really expected. And of course, that has added additional issues to the Brexit happening. But all trade arrangements have an element of uncertainty to them, especially when a trading relationship has fractious dialogue. Yes, Brexit has been, has happened, but it's not really completed in the way that we'd like it to be. We have the free trade agreement, and it is a pretty good trade agreement. And there was a lot of thought and effort was put into it. And so the nature of the agreement between the EU and the UK tried to keep it as close as our previous agreement was, with trying to keep as much movement of goods. The difficulty is, of course, is we're now separate entities and no longer part of the same customs union. So concerns should be understood regarding how this relationship will continue in the future. There's still a lot of work going on in the background as to how the implementation of the free trade agreement are being put in place, and the lot of effort was put in, but of course there's been a lot of movement in the implementation of some of the processes. So free trade agreements can be amended and retaliatory mechanisms can be put in place. Tariff and non-tariff barriers could be put in place by either party. So I could go on, but
I'll leave it there. I think you're going to be talking about some of those issues in the presentation itself. So yeah, let's move on to the next slide. A lot to get through today. I was about to say, I didn't say your job title quite right there, Hamish. You're the Customs Specialist Team Lead. So yep. My apologies there. But yeah, let's get cracking and let's get going to begin the presentation with a little slide about why we're here and the suite of support we're launching today. So over to you, Hamish.
Thank you. So the Institute of Export and International Trade realised that, as you're aware, there's a lot of uncertainty as to the way things are moving forward. These are uncertain times, not just because of Brexit, but also because of the global pandemic, and it has altered the perspective of international trade. So as a consequence, the IOE is starting to put things in place to try and help. We're increasing the real-time export and import planning support we offer to members with our new Trading in Uncertain Times suite. So this includes real-time news alerts, enhanced telephone helpline, and this is for business members only. There's new live web chat function giving expert answers to your questions. We've expanded the range of webinars, which this is the first of. There's new one-day training course with dynamic content taking account of developments as they happen, and then there's the new consultancy package focused on managing trade change and risk. Next slide, please. So if we have a look at the agenda for today, what is trade uncertainty? Trading goods, tariff and non-tariff barriers to trade, trading services, quantifying trade risk, and then how traders can plan for uncertainty, and we'll finish that off with a question and answer session. Next slide, please. What is trade uncertainty? So if you search the internet for the term economic uncertainty or close variations, you'll find what you already know just living through the current times. It's the default word to describe the uptick in political and trade tensions and in the precarious health of the national economy, as well as our personal economic lives. For example, there was widespread fear that the recent economic downturn would result in a substantial increase in protectionism. The impacts of uncertainty generated by the global pandemic are clearly much higher than the trade uncertainty associated with such things as the US-China trade war and indeed Brexit. Trade has historically served as a lightning rod for political dispute, and such changes are highlighted in trade policies governments can use. China's relations and the West soured after 1999 Tiananmen Square incident, prompting a fall in international trade investment. We then have things such as supply side shock, which is a rise in oil prices or rise in commodity prices would cause an increase in the cost of production for firms. And then you also have demand side shock, and this is a global economy downturn which will have a strong impact on reducing growth in all countries, thus creating financial instability. Next slide, please. So we now look at the things such as trade tariff or tariff barriers. So the most common barrier is the trade tariff or customs duties. So when imposing a tariff, the name by which they implement that function as a trade or a tariff barrier, the price of the goods or services increases depending on the characteristics and volumes of the transaction. This makes it possible to defend national product against foreign competition in case of imports. And in this way, national production is facilitated instead of acquiring these products outside the country. But tariff barriers not only make products more expensive, but also help to control taxation and the legality of trade, since it facilitates knowing what the goods and exchange service are audited, and therefore if they are legal. As a result, the country imposes tariff gets more revenue from tax collection while balancing prices with a view to selling its products in foreign countries. In such a way, the greater internationalization and ability to export the more revenue a country can generate, and the better it can stabilise the prices of its product. Another use that some countries often give to tariff barriers is a protection measure against foreign capital investment. It usually occurs in countries that attract the entry of capital due to their favourable condition for investment, thus hindering this arrival through tariffs. A good example is that of the US imposing tariffs on over $7.5 billion worth on US exports. And it is the latest chapter in a 15-year battle between the US and the EU over illegal subsidies, particularly for plane makers Airbus and rival Boeing. The World Trade Organization ruling will mean tariffs in EU goods ranging from aircraft to cheese, olives, and jumpers. In addition, it has also hit, Trump administration imposed a 25% US tariff on Scotch whiskey over aviation subsidy dispute. And obviously the distilleries have reported £600 million loss since the beginning of this dispute. You probably imagine with the name Hamish Mackay, I'm actually a little partial to a drop of whiskey. I'm not sure I'm overly happy with the way that's going. Obviously we can buy it cheaper, but anyway, next slide please. So we then look at non-tariff barriers. A non-tariff barrier is any other measure other than a customs tariff that acts as a barrier to international trade. These include regulations such as which dictate how product can be manufactured, handled, or advertised. So a non-tariff barrier is the application of trade measures designed to limit import and export of a country or continent, and this practice is the result of a political decision whose reasons and motives vary according to the different cases. This policy can be adopted in case of health and safety risks, as well as in the event of non-conformity of goods or their packaging. Protectionist measures regarding the local economy are also amongst the reasonings given to justify the trade barrier. Why does that matter? Well, non-trade tariff barriers can be more restrictive for trade than actual tariffs. During the second half of the 20th century, multilateral trade rounds dramatically reduced tariffs. In 1949, the US charged an average tariff of 33.9%. Today, it is 3.5%. The EU's is 5.3%, while China's is 9.5%. So except for a few sensitive products where tariffs remain high, it is a non-tariff barriers that are the real impediment to international trade. A 2009 study of the trade policies of 91 countries found that non-tariff barriers were equivalent to a 12% tariff barrier. The UN Conference on Trade and Development found non-tariff barriers contribute to more than twice as much as tariffs to the overall market access trade restrictedness. What non-tariff measures might apply to the UK and EU relationship? Well, most of potential new EU-UK relations will involve new non-tariff barriers to trade with the EU. One of the advantages cited of leaving the EU is the freedom not to adhere to certain EU regulations. But regulatory divergence from the EU may make it harder to trade goods, introducing non-tariff barriers. So if the UK signed a free trade agreement but left the EU customs union, any goods crossing the border would have to meet rules of origin requirements to prove that they did indeed come from the UK, introducing paperwork and non-tariff barriers. Are non-tariff measures the same as non-trade tariff barriers? Well, technically the two are different, although in practice these terms are often used interchangeably. Some non-tariff measures are not actually barriers. Instead, they can increase the volume of trade. For instance, a country might require that all food items must be labelled in a certain way. While this might introduce an administrative burden and cost on imported goods, it might also give consumers more confidence to buy if they can see that foreign products conform to social standards. Another example of non-tariff barriers is product conformity. In particular, things like we now understand that CE marking is no longer relevant in the UK. It now has to be the UKCA. But we also have things like SASO in Saudi Arabia, where Saudi Arabia require that every company that manufactures electrical goods must adhere to the Saudi legislation, and part of that is you must get it certified to that level and have a specific check done, and it must be by an authorized Saudi company. Next slide, please. So we also now look at trade in services. Services are a major part of the global economy, generating more than 2/3 of the global gross domestic product, or GDP. So market access limits can be placed on the number of foreign suppliers or total number of service transactions. For example, the on-demand services Netflix or Amazon may face demands that say 20% of their catalog they offer should be made locally. Regulatory requirements, so laws that aim to protect the public from malpractice or fraud, can be the most common barriers to trade in services. For companies, these can include licenses to provide a service, like banking licenses, nationality requirements for boards of directors, or capital requirements such as for financial institutions to lend. For a person, it can mean requiring national qualifications to provide a service, like those needed to be a doctor, accountant, or lawyer, without recognising qualifications given to the people in other countries. For example, meaning a lawyer that qualifies in Argentina cannot not practice law in the UK. Finally, there are standards governing the services themselves, like data standards describing how data should be described and recorded. Relations on workers' movements of people, any restrictions on short-term business visitors, intra-corporate transferees or independent professional travelling to provide a service. These can take the form of restricted work visa requirements, or for example, short-term business visitors to the EU can stay up to 90 days within a 6-month period. Next slide, please. Risk management is the process of identifying, assessing, and controlling threats to a company. The risks stem from a variety of sources, and you can see here country risk profile, financial risk, legal risk, technology risk, and international trade risk. The country risk profile can be looked up on the internet. Companies such as Transparency International give it a good example and actually do a report on country risk of each country's. Financial risks, predominantly these are things like anti-bribery and corruption. It's very important that you understand who your business is and how they're going to pay you. It's difficult to get paid if the country that you're doing business with has sanctions on financial sanctions, and the bank can't, the company actually can't pay you because the bank has got restrictions. So understanding the dynamics and complexities of international trade is important for buyers, sellers, and lenders. Managing risk is the key to a growing success for trading business, either internationally or domestically. Late or non-delivery of goods, foreign exchange, and country risk offer new and unique challenges to the would-be international trader. Next slide, please. So what should traders do? Implement risk management model, consider shipping risks and insurance covers, ensure that you access the country risks for the countries you're doing business, assess your customer portfolio, and be aware of the exchange rates between the companies, your countries, you're doing business. Access or assess your supply chain setup, assess tariff controls in place, and investigate special customs procedures. Next slide, please.
Thank you.
I
think it's back to me. Yeah, thank you very much. A really concise introduction on something that is clearly a huge topic, something we've indeed just launched a whole one-day training course and consultancy regarding. So we hope that's given everyone at least a flavour of some of the support we'll be offering in this area. We'll head into the questions now, and I'm delighted to be joined as well by Arshad for this part of the webinar. Hi, Arshad. Something I'd like to pick up with you from Hamish's presentation is around tariffs. So obviously tariffs are a significant barrier for goods trade, but what situations could come about whereby tariffs could be introduced for trade, or kind of what impacts, what brings in tariffs, as it were?
Okay, well, thanks, Will, and thank you, Hamish, for an informative presentation. It's great to be on. Hamish has explained in detail. There are two types, of barriers. One are sort of origin and regulations, etc., is a barrier to trade, so it makes it difficult. And the other way of introducing barriers is through tariffs. Now, generally, there are two, broadly speaking, there are two scenarios where tariffs will be introduced. One is political, and the other one is economic. Economic is generally there to protect domestic industry, domestic products, and to make sure that bringing in cheaper imports doesn't impact jobs and the economy domestically. So what they try and do is they try and make the imported products more expensive, and therefore making locally sourced, locally manufactured products or services cheaper, and therefore giving them a little bit of an advantage and promoting domestic trade. Some examples, for example, in Malaysia, where they introduced the first sort of homegrown car, Proton. When they had that in there, they'd introduced tariffs for foreign imported cars. So your Toyotas and your Nissans, Mitsubishis, and all the other foreign imported cars became expensive, and that gave a boost to Malaysian car production. And if anyone's ever been to Malaysia, you'll see still many cars, many Protons on the road. And it gave that lifeline to a domestic a national project, and gave them that push and that boost to jobs, to R&D, and it made a country who was principally an importer of cars now a manufacturer of cars, and it gave them that sort of confidence to then go out and trade internationally. Hamish has mentioned the dispute between Airbus and Boeing around subsidies, and one of the ways they retaliated was putting taxes on Scottish whiskey and tweeds and cashmere, etc., etc. So that's another reason. I also mentioned political. So a few years ago, I think 4 years ago, we saw the economic blockade of Qatar. And therefore, I mean, that wasn't a legal thing because it didn't go through the international courts, it didn't go through the United Nations, but it was a number of Middle Eastern countries, principally Saudi, the UAE, Egypt, Bahrain. They all got together and blockaded Qatar economically. So no business, no trade, no services, no movement of money, was completely blocked. And these were for political reasons. So there are ways, and a number of scenarios that can this occur.
Thanks, Sasha. That's really interesting. I had no idea about the Malaysia story as well. So, well, not story, it happened, but yeah, really interesting. Great examples. Particularly interesting, obviously, Hamish being a whiskey drinker. Good to hear about that example again. And obviously, I think that those tariffs are currently suspended, if I'm correct, because I think there was a settlement to suspend that particular dispute, but it did have a major impact for a number of years. Bringing it back to the UK then, the UK kind of context, I mean, Hamish, in what kind of scenarios in the UK-EU trade climate at the moment might the tariffs come back in, given that they are at least nominally removed through the trade deal?
Okay, so obviously the biggest issue is Article 16 with the Northern Ireland Protocol. So if, God forbid that happens, but the reality is, if that was to be called, the EU have said that they will withdraw the EU-UK TCA. And by withdrawing the EU-UK TCA, what that means is we go back to what is called most favoured nation status. So we go back to the standard World Trade Organization rules of origin and tariffs. So all the tariffs that have been agreed and reduced within the trade agreement would go back up to the same as any other country that has no trade agreement. Effectively, it would mean that we are doing business without a trade agreement. So every product, regardless of origin, we would be paying duties and taxes on when we import them from the EU, and vice versa. Anybody buying in the EU would be paying duties and taxes. Equally, if that was to happen, we could find that certain countries might even try and put increased tariffs on some of the movements of certain types of goods. So again, we could find ourselves with, I mean, I'm hoping it's not going to happen, because we already seen movement in the agreements between Europe and the UK over the Northern Ireland Protocol. But that is what would happen realistically. That's the sort of thing that we might find ourselves facing if any changes were to come in Europe.
And if I'm correct in my understanding is that it very much depends on if the UK were to trigger Article 16, it depends on the extent to which they do that.
Yep.
So they could suspend certain measures within it, which may trigger a very specific EU introduction of a tariff or particular new I don't know, restrictions. But if the UK was to do suspend a large part of the protocol, even in its entirety, then the EU would then maybe decide to withdraw the trade deal. There are timelines involved in that, though, aren't there? The UK can't just trigger Article 16 overnight and suspend those rules, and the EU equally cannot just suspend the trade deal overnight as well.
Absolutely. And one would hope that negotiations would be ongoing and we'd be able to come back to a mutually beneficial agreement. It's one of those catch-22s, as I say, when with both the Northern Ireland Protocol and the EU-UK trade agreement, a lot of stuff was put in place without really understanding the impact of what they were putting in place and how it was going to affect us. Of course, we're now seeing the impact of that on an everyday basis.
It's also important just to add that when it was all introduced and agreed, the window, it was in the last week of August, it was last week of December, if you remember. I think it was a few days before all the businesses shut down and we all go away and enjoy the seasonal break. So when it was announced, many businesses were caught out, and they didn't really have the time to prepare. And it all hit them when they started back in the first week of January that, oops, we've got all this to now manage.
It's a really good point. I mean, with the trade deal, that's obviously massively important with the Northern Ireland Protocol, because that was agreed to in the withdrawal agreement, if I'm correct. So that's having to also interpret two different agreements, one of which is just a week before, the rules introduced for UK exports to the EU and then for Northern Ireland. And obviously, there's still parts which businesses are needing to untangle at the moment with the border controls and imports being introduced largely in phases, a lot of them on the 1st January this coming year. So there's a lot for traders to get their head around. Just in the interest of moving on, because we've had a few questions in, so we've also got a few more questions for you. I'm just going to launch another poll quickly, actually. So just going to ask your audience whether you've needed to call on external support or hire additional staff to deal with new trade rules and processes since Brexit. So external support, additional internal staff, or neither of the above. So hopefully that's an easy enough poll to respond to. While you're answering that, question from Jamie, who said, throughout the pandemic, supply chains and global shipping has seen a lot of disruption. How can traders continue to mitigate uncertainty stemming from the pandemic, especially given the recent news stories about the Omicron strain? So Hamish, do you want to tackle that one first?
Yeah, sorry, I didn't catch the whole question. I do apologise. Could you just
sorry, which is around pandemic and how kind of companies can continue to mitigate and plan for it.
Yeah, absolutely. So business leaders should probably begin to assembling the foundational elements of the operating model so that they can steer their organisations under conditions of extreme uncertainty. Obviously, we are in that place already. Key areas that should be focused on is trying not to set specific dates when a revenue rebound could occur, as this leads to false expectations. You need to try and create an early warning system. So a fundamental operating principle in normal times is for businesses to develop an understanding of the kind of events that might trigger a crisis. This will allow them to establish appropriate monitoring and early warning systems. Develop an understanding of your supply chain model and adapt this for more domestic supply, as we saw lack of materials, saw lack of product, and therefore revenue. It's very easy to say that. I appreciate that, and unfortunately, hindsight is quite often the best way forward. But yeah, I think there's about as much as I can say on that. Thanks. Sorry.
There's another couple, if I may. I mean, we've looking at the supply chain and reviewing that, but we can also look at our agreements, our contracts with both suppliers and also our clients. and if there are penalty clauses in there that sometimes are in many contracts, this is an opportunity to review those penalty clauses and renegotiate, because sometimes pandemics, as we learned with COVID, it does impact supply chain, and if there isn't sufficient protection in your trade, in your supply and your both your purchase and your supply agreements, then perhaps you can look at those paragraphs with some legal advice and make them more robust.
Thanks, Arsha. Thanks, Hamish, as well. I hope that's answered your question, Jamie. Do one last poll and one last question, just as we're starting to run out of time. So the last poll is asking, has your business taken on any additional training to adjust to new post-Brexit trade rules and processes? I'll share the results of both of those polls in a moment. Just wanted to touch on services. So a question from Sam has asked, my understanding is that the trade deal with the EU was quite thin on services. What are the rules for services traders with the EU, and how could these change in the future? Arshad, do you want to start on that one?
Well, with services, exporting services has always been difficult. It's quite a tricky process, and the agreement does talk about services and covers it. But in terms of delivery and managing, the way to manage that is to have a fully documented process in terms of where those services are being exported to, how, and what the tariffs are. That's really the way to manage that process. Hamish, is there anything you want to add to that?
Yeah, so there's a number of things we could say. So obviously for businesses that import services from the EU, there should not be significant immediate changes, except in the case of some financial services. And if you have a UK business, you might face restrictions on your ability to own, manage, or direct a company registered in the EU. New professional qualifications are no longer automatically recognised by member state authorities. So this means UK professionals will have to comply with professional qualification requirements in the EU member state that they want to sell the service in. So any further breakdown could lead to difficulty accessing data, or restrictions on storing or sending data, limits on border transfer of personal information, for instance. Obviously, there's issue with fees that only apply to foreign service suppliers. For example, unnecessary charges on foreign suppliers that give an advantage to domestic suppliers. So in some instances, it may be a requirement local presence is required, for example, requirements for a service supplier to be a resident or from a local enterprise. So I could go on, but we'll leave it there.
And thanks, both. It is actually a topic we ran a webinar on early in the year. So yeah, if you go into our YouTube, you might find the recording to our services webinar. But it's a lot of information. There's a lot in the trade deal, but I think there's a lot in smaller agreements to the side of it as well, is my understanding. So again, it's another one where there's lots of information which traders need to get their head around. But we are running out of time. We've run out of time, in fact. I'll very quickly share the results to the polls because I think they are quite interesting. So 45% of you have hired external support to help new customs processes, particularly agents or freight forwarders. 20% of you have had to hire additional staff, and 35% of you neither of the above. Not too surprising, as you expect that a lot of businesses will hire agents or forwarders to support with those new processes. And then the last poll, encouragingly, a lot of you have done training to adjust to new trade rules. 65% of you have, 35% not. Yeah, that's very encouraging to see. And obviously there's training from organisations like the Institute, which you can make use of if you need to do more in that area. But yeah, as I said, we've run out of time. Thank you once again to Hamish and Arshad for the presentation and answers today. Really interesting stuff. It's a massive topic covered in not very much time, so we hope you found that useful. Before we go, just a reminder that today's webinar comes shortly after the launch of our new Trading in Uncertain Times suite of enhanced support, helping traders to continue trading despite Brexit uncertainties, global supply chain issues, and all the ongoing geopolitical tensions, many of which we haven't even talked about today, climate change, technological disruption, so much going on in the world, of course. As Hamish mentioned earlier, that suite includes real-time news, an enhanced telephone helpline for our business members, a new live web chat function, a new one-day training course and consultancy, and more webinars just like this one. For more information, please do visit export.org.uk/trading_in_uncertain_times. We'll send the slides with the links. That would be easier than listening back to my drabbling on. But for now, thank you everyone for tuning in. We look forward to seeing you on the next one, and goodbye.
Thank you.
Thank you.